Well, howdy, and thank y'all for the opportunity. I really can mean it that way, too. It's an opportunity and one that I really cherish and appreciate Reister inviting me back to be a prof for the day. The credentials and some of the awards and the listings aren't intended to be bragging points, and please don't take them that way. I just, more than anything, want you all to realize that the importance of giving back is beneficial to each and every one of your careers going forward. I think that investment in your community, in your church, and what you find to be your passion in life, nonprofits, whatever the case may be, all of those things are ways of giving back. And not to mention they're giving back and providing benefit to the folks that need it, maybe more than you and I do. And so giving of time, talent, and treasure, never forget the importance of that, because it's really critical. I've got a whole lot of information, more that I'm going to be able to get through. And so I'm going to cut some of what's in this presentation out and kind of fly through it. If you have a desire to get more of it, maybe you can get the set from the PowerPoint slides from Reister or Merritt. But I'm going to, again, cover a lot of information and try to leave you some time for some questions that are near and dear to you all. So this in particular, I'm going to fly through really quickly. This is about the bank. We're about a $38.5 billion company as of year end. Today, if our most recent acquisition, which is Stellar Bank out of Houston, that acquisition alone is going to be about $10.8 billion in assets. Those of you that know Joe Swinbank, I believe his name's on the outside of a building somewhere right around where we're sitting. And Joe is actually on the board of directors for Stellar Bank through an acquisition of a former bank that he was a part of. So I'm glad to be on the same team, so to speak, as Joe going forward. We have not yet closed on that transaction. We bought American Bank down in Corpus on January the 1st, and then we bought Texas Partners Bank out of San Antonio. We closed on them in February. The Stellar Bank transaction, you say, what are you guys doing? 3 acquisitions of that size in less than a year. What are you guys doing, or what are you guys thinking? And the Stellar transaction itself was not really planned for now, but that's just we had approached and thought we had a deal, a handshake made about 12 years ago with the folks with Stellar Bank. Their senior executive management were about my age, in their mid-60s or so. Well, fast forward 12 years, you would know about what their ages are now. So they were much more apt to talk about selling the bank now than what they were when they were, I'll call it young bankers, because I want to consider myself a young banker. So the Stellar transaction has not yet closed and is still subject to regulatory approval, but in all likelihood is going to take place. So we'll pick up another 52 banking locations in the Beaumont and Houston area. We will be the largest Texas-based bank in the Houston metro area after that acquisition takes place. That'll put us with about 106 to 108 locations. Some of those you can throw a rock and hit our branch and hit their branch. So obviously some of those will go dark, and we'll just combine staffs in those banking centers. For the most part, just what we try to do, and in this case, all 3 acquisitions that I've mentioned. Everybody that's customer facing, meaning all of the employees that deal with the customers, everyone has a job. So there's no layoffs on everybody that's customer facing, because you don't want any customer service to be disrupted. I mean, those are where the banking relationships are anchored, right? Everybody wants to have somebody as their banker. And so that's the way we try to approach those acquisitions. Yes, there's some savings in backroom functions. You don't need duplicated accounts payable and payroll departments and HR departments and those kind of things. But what we do is we usually, through the acquisition period and for at least a year after that, for 2 reasons. One, you're going to have some attrition, right? Some people retire, some people leave, medical reasons, whatever, particularly in a company our size, which after this acquisition, we will have nearly 6,000 employees across Texas and Oklahoma. So with that attrition, you'll save some of those jobs that would otherwise be gone in the back room that I talked about. And then the other aspect of that is when you see those things happen, not only does attrition take place through retirements and that type of thing, but people find jobs elsewhere. And so we do what we call stay pay. We want those people to stay on to really keep the transition smooth, and they don't suffer any economic, personal, financial consequence until theoretically they own a job. Yeah, it's got an end date on it, but it's way out there. And so that's our way of being a softened blow on an otherwise acquisition. When you say, well, people are going to lose their jobs, they do in some cases, but not very often. Attrition takes care of about 80% of those jobs. One of the most interesting things about us, I'll focus a little bit more on South Texas, which is the area that I manage. Currently have 33 bank locations. With the acquisition of American Bank, that jumps by another 16 locations. Really all that means is that I've got some loan approval and management responsibilities over those areas. But by and large, between banking center managers that manage all of the retail side of banking, the deposit side of the bank, if you will, and then lenders that we have in each of the banking centers, we call them banking center presidents. They earn the right to be called that in each of the banking centers that we have lenders in. Some of them are so small we won't necessarily put a lender in them, and we'll have them maybe 2 branches covered by 1 lender. But that's typically how we structure those things. So that's the team. They're the ones that really make it work. I just answer the phone and approve deals and answer emails and do what I do best, which is, just try to just herd the cats and keep things moving in the right direction. As you can see from the financials, and I'm not going to go over them in any more detail than that, we're highly profitable, not only as a bank, but as in the South Texas area as well. We've done really well. And then one of the last things, the number 10 item I wanted to point to you is last year we had one Panhandle bank that was larger than we were as far as Texas-based commercial banks. So I'm not counting the Wells Fargos and those guys that are headquartered out in California that have banks all over the United States. But in terms of Texas-based banks, we're considered the number 1 agricultural bank in the state of Texas. That's leaving out the farm credit guys, the capital farm credits and the ag trust guys and that type of thing. This is commercial banks, depository commercial banks that specialize in agricultural lending. So what this slide is intended to do, just real quickly, is just kind of talk about, what is the prospective borrower desire when he's seeking an ag banker or an otherwise. The way I look at it as an employer is, what am I looking for in terms of the skills that I think we can develop from someone that's graduating with a degree in rural entrepreneurship or agribusiness, or as far as that goes, they may be with a finance or accounting degree in maize, but by and large, Ed knows that our sweet spot is from the College of Ag. And I'll tell you why, real quick. 1, I graduated from it. And 2, I think students of this college, in particular students that come out of programs like this, have a stronger work ethic and really know where the ground meets the rubber on the sole of their shoes and how things really work. A lot of that is in this real entrepreneurship class. Right, I don't know how many years ago it was, 30, 35 years ago when you started this, and we had some brainstorming sessions about what does A&M need out of ag economics and the agribusiness program. And we said we need practical application, real live work things that happen, business models, business plans, and things that really happen in the way we look at them when we analyze them as bankers, and the way you want to look at them when you're taking them to a financial analyst or even private equity investor. So, starting off, it's not unique to agriculture. Ag lending is nothing more than a subset of commercial banking, right? You're a commercial banker first. Just so happens you happen to have some specialty in agriculture. If you don't, it's no different than an energy and oil and gas lender. I don't want to be an oil and gas lender because I don't know enough about it, and I'm going to mess it up. I'm not going to know what I'm looking at and how to analyze what's going on under the ground in oil and gas reserves. That's not me. We talk about an ag deal, I'll get my hands dirty with you, so that's really what's intended there. And then obviously the lender needs to have the expertise for whatever the business or profession is that's being financed, like I just said. Does the bank have the risk tolerance for the type of of business that you're in. Are they good at it? Do they want to make ag loans? Do they want to make energy loans? Do they like multifamily? Maybe that's the specialty on the commercial real estate side. Do they not like hotels and motel loans? You know, we're not a big fan of those at Prosperity Bank. We do them, but we're going to do them with a lot of skin in the game, a lot of equity, if you will, or deals that may have a lot of cash flow. Maybe it's somebody that owns 10 properties, and so the one that they're acquiring is supported by the cash flows of the other 9. And so everything works together when you look at it globally from a cash flow perspective. So, and then the last thing just mentioned are the policies and guidelines of the bank. Do they match really what fits your business model and what your business needs are? And that's really just more than anything loan covenants. Say we put a liquidity covenant on a borrower after the loan is made and say, gee, you need to maintain liquidity on your balance sheet or a current ratio of X or Y. And what does that really mean? Why are we doing that? Some banks just standard application. If you're going to do business with this bank, you're going to have a coverage ratio of 1.2 or greater. And that's just a standard policy. We don't do that. We look at the business and we look at the underlying risk factors that are behind it. So those are just things that we like to consider. And then the other things are just kind of a subset that I put down there below. The one thing that I did want to bring to your attention, the second to the last bullet, other than the very last one about professional development, is never stop learning. I mean, to this day, that's something that I thrive on, is learning more each and every day that I go to work and be a part of this process. But the branding of yourself, I don't care what profession you get in, one of the things that I did wrong early in my career is and part of the reason why I'm here is my ag expertise labeled me as an agricultural lender. And in the banking world, commercial banking is sometimes thought of to be a separate animal or not really the subset that I talked about earlier. Ag is nothing more than a subset of commercial lending. It's just a different type of inventory. Stockers and feeders and cattle on feed are still inventory, right? But they're not widgets on a shelf. They're not inventory on a shelf. And so understanding the difference, and my favorite story is the one that when the regulators came into the bank and the senior examiner basically in charge of the exam that was about to happen, she's sharp. She's good. She knew cash flows. She knew everything to ask. And she was going through what we call a borrowing base, which is an inventory certification report that we use on our ag loans. So if you're a cow-calf producer, it's cows, bulls, calves on the cows, weaned heifers, weaned steers, replacement heifers, 2-year-old breds, those type of thing. If you're in the stocker yearling business, it's, stocker steers, stocker heifers, feeders, cattle on feed, and you're giving us numbers, and then we're converting those numbers to dollars, and that's the inventory. Well, she went going through the borrowing base classifications, and she said, I know what a cow is, and I know what a bull is, but what's a heifer? And I didn't understand what she said. She wanted to know what a heifer was. I mean, she was asking about a heifer. Didn't even really know how to pronounce it, much less know the difference between a steer and a heifer. But back to the point of you got to kind of know what you're looking at if you're going to be good at it, and so. And the branding aspect of what I talked about is just that. Make yourself a commercial banker first, and I specialize in agribusiness lenders, and I tell my lenders that all the time. You want some commercial deals crossing your desk, just like you want ag deals crossing your desk, and it's just important to always have that broader base, because it increases your value on your resume and in years of experience. So when I look back now, and again, now I need to speed up because I know I'm going to run short on time. Attributes of failing businesses. We hindsight's 20/20. You can always make it right. The other story that bankers always say, well, it was a good loan when I made it. What happened after that? Well, sometimes it doesn't always work out. So some of the reoccurring themes that I've seen over 44, almost 45 years of banking is the first one being the most obvious: lacking management, commitment, and discipline to make tough decisions, and more importantly, timely decisions. Make those tough decisions early on. Did you have a management plan in place, and did you follow it, and did you evaluate what could be the negative outcomes of that plan? It's as important to evaluate what the negative outcomes are as much as what the positive. We know if everything goes right, it's going to work like this. But what could knock it off the tracks? Empowerment without accountability in any business. You empower people that work for you. It's kind of the same thing with a bank like ours compared to some of the big money center banks. I'll just refer to them. The really big banks, they keep all of that authority in a high spot. Conversely, a lot of the really, really small community banks, let's just call them family-owned banks, that's their money, right? If it's family-owned, that bank is theirs. It's just stock in a bank. So they may withhold that authority to approve deals to that board of directors, which may be mostly or all family. That's sometimes tough. They like the deal, that's great. If they don't like the deal, that's not so good. Are they gonna really want to give that accountability out to the folks that are making the relationships and interviewing the applicants? A bank like ours, we really believe in empowerment, but with that goes accountability. So we push lending authorities out to our branches, to these banking center presidents. We make sure they know that they're accountable for that. Will things go wrong? Will loans show up on the past due list? Absolutely. It just happens. It's the nature of lending. But they're accountable. They've got to work their credits, and they got to continue to look for ways to improve any situation that's maybe not as palatable as it once was. We all know about shock analysis. I'm not going to talk a whole lot about that. All I'll just say to that is, we use 15% as a shock because of the nature of agriculture in particular. You got weather, you got prices, you got expenses on the expense side of the income statement. Whether it's fertilizer cost or whatever the case may be. Is 15% shock enough? Well, let's think about COVID, or go back to COVID and what it did. You had commercial buildings, that were fully leased out, 100% occupied, paying rent, paying leases if you were the building owner and you had debt on it, and you get in the middle of COVID and everybody's working from home and the offices are dark and everybody quits paying their rent. What do you think that feels like? You think 15% was enough? That's just an example of what it can go wrong. So we just know that we have to do some shock analysis in everything that we do to make sure that we at least evaluate things on a stressed level. And then the last thing that I really want to mention that can really knock a business off its feet is easy credit availability. A lot of times that happens from your captive finance companies. I'll pick on John Deere Credit or Case IH or Kubota Credit for depending on what color paint you like on your tractors or your implements. And so 0% financing, 100% financing. You walk in there with a good credit score and a pulse, and they'll make you a 100% loan. I can recall a borrower 2 years ago, mind you, with farm commodity prices where they are now, which are at all-time lows. I don't know that the cash flows have ever been tighter on a true crop production loan than what they are right now, based on what cost of production have done and farm commodity prices as low as what they are. So you look at a balance sheet a year ago and a farmer's almost completely out of debt, and you look at it a year later because he just decided it was time, and the salesman at the implement dealer talked him into some 0% financing. A year later, he's got over $1 million worth of equipment debt to service at these commodity prices the way they are. I can tell you, had it not been for that, our Secretary of Agriculture and Trump's bailout money that they all got about 2 months ago, that borrower might not have been financed, period. We even had to put an FSA loan guarantee. So FSA, that's Farm Service Agency, part of the USDA, and we're a certified lender. So we can, if something's really weak on a credit, we can ask the government to help us with a loan guarantee for some period of time. In this case, it was what we call an OL, the operating loan guarantee, in order for us to bank the borrower going forward. And then we have to do things like those loan covenants I talked about earlier. We got to go back and tell the borrower, okay, this is the bank's money. This is our shareholders' money. We're not an investor in your business, right? We're a lender. We want it back, and we have to get it back because it's our shareholders' money, not ours. And so we've got to put loan covenants in place. It says no more capital spending over $10,000 or over $50,000 without written consent from the bank. Well, up until that expenditure or that $1 million worth of expenditures, that borrower didn't need that discipline in place because we trusted that everything would work like it needed to. But now that covenant's in place because we don't want to get caught in that situation. And so now it's an event of default. If that borrower does that, at least if we recognize it and we find it, we can hopefully stop the bleed sooner rather than later. And then the attributes of successful businesses. The main thing is, a good, strong product and again, you all know this. Cash flow cycle is the main thing I really want to talk about in these bullets here. We already talked about break-evens, but the cash flow cycle can really gobble up. What we always get concerned about is relationships or borrowing that have lots of inventory. Or any type of service type receivable. If you're delivering a service, let's first talk about the example of an inventory. You've got a lot of inventory on the shelf, and let's say that one item, you sell it twice a year or 3 times a year. So it turns 3 times a year. But yet, to get that sold, if they don't pay cash for it at the counter, you got to bill them for it, then you got to wait to get your money back from them. But yet, on the vendor side, when you're buying that item to put it on the shelf, they want net 10-day terms. Or if you want no shipping costs for them to deliver it to you or a surcharge, so they want their money in 30 days or less. So I'm getting the money from selling that inventory item once, twice, 3 times a year. Every 3 months I'm selling one of those items. Yet if I go buy 3 of those items, they want their money in 10 days. What does that do to our checkbook? So matching payables and receivables as close as you can to inventory turn. What it's also telling you is what? Don't put inventory on the shelf that doesn't turn. Don't do that. Don't buy 10 if all you're selling is 2 a year. Buy 5 or buy 3. And so those types of things, because then you won't have as much of your money tied up. Conversely, let's say you're in a service business. And so same thing. You've got labor, right? You got a crew that's going out there and delivering this service. Nails in a board, welders, whatever the case may be, and you're paying those people weekly, maybe bi-weekly, maybe once a month. But yet you bill the company for that service and that money doesn't come in for 45 days, 60 days, 90 days. What does that do to your cash flow cycle? Same thing that the inventory does to it, right? And so managing cash flow is so critical in any type of service business and in any type of heavy inventory business to make sure that you look for ways to match that. And that's why you see a lot of people giving discounts if you'll pay me. Same thing, just like the vendors want their money quick. If you can get the customer to pay you that much quicker, you'll probably want to discount that for the opportunity to get that money back sooner. Otherwise, you're probably going to be paying me at the bank interest on a working capital line of credit, which is going to have financing charges to go in there. So you might as well have given the discount if they're willing to pay you sooner, right? I'm not going to talk anything to speak of about this. This is more just about when we make a loan, here are the steps that we have to go through. First on the front end, we're considering what the loan structure needs to look like. Is it a working capital loan? Is it permanent working capital? Just a one-time shot? Someone needs $200,000. They're willing to secure it with some equipment or a piece of land or their building and then put it on a payout. They don't need a line of credit per se. Is it an asset purchase? Some type of equipment? It's livestock. It's a piece of land. Or is it carryover debt? Carryover debt meaning operating loans from 25 that could not be repaid from the 25 crop, as an example. And so they've got carryover debt that they've got to figure out a way to get paid out of future operations. Underwriting, that's just talking about strictly the steps that we go through in terms of evaluating the borrower and what the request looks like. What our collateral requirements are, just thought I'd list those there in terms of how much we loan. As an example, the first one listed there, we loan 75% of cost or the fair market value of livestock. But I'll give you a quick example of what's happened in the last, say, 12 months. So we've had borrowers that have been very, very disciplined buying cattle, and we've given them lines of credit, and they said, okay, I'm going to hedge everything. I'm not going to take any market risk on the cattle that I own. Say they're buying feeders that they're going to grow into live fat cattle all the way to slaughter, and so they want to hedge that market because they've got a profit made in those cattle. What has the cattle market done over the last 8 to 12 months? It's done that, right? Just skyrocketed. So the cash market and therefore futures followed to some degree, not quite as much, but the markets blew right through. The cash markets blew right through their hedge positions. And so they're margin calling, and they're paying the Chicago Merck for lots of money for margin calls because of the positions that they took. So they're gut checking me. John, my banker, you still there? I'm going to need you. I'm going to make a $600,000 margin call tomorrow. So those are, those tend to wake people up, particularly if the line of credit that they have with us isn't enough and they've already blown through their cash making margin calls. We got to be pretty nimble and pretty quick on our feet and have an understanding of their business model, that they're hedged. And if we just ride it out with them, chances are they're going to make most, if not all of that, or maybe more than that, because cash basis was positive during this period of time. So they're selling the cattle on the cash market higher than what their hedge loss was. So it's just a function of the way we do business. And then the monitoring, we've already talked about that briefly. So what other areas do we have to spend a lot of time in? In our commodity pricing, I'll go to that last bullet first, the one that says PB CPI. So what we have to do to be consistent within the bank, obviously if you've got some, let's just say 3,000 lenders across the footprint of the company and everybody wants to make an ag loan, more times than not, those that are making the loans out of the 3,000, there's about 20 of us that regularly make ag loans. Everybody else they're the relationship manager for a doctor. Well, the doctor's got lots of money and he wants to have a second home and he wants to buy a small ranch and he wants to build a barn dominium on it and he wants to finance it with the bank and we're his relationship holder. So that lender, who is a P&E doctor lender, is now making an ag real estate loan. And so we don't really worry about those guys because they're going to underwrite that no different than they would a home mortgage, right? It's a doctor with a salary and he's making money and you're going to do a global debt service analysis, make sure he can pay the debt, and you're going to make the loan. What I'm talking about here is our regular lenders that have, the actual collateral securing the loan is what we call cows, 1, 2s, or 3s. Well, are they young and cattle that can stay in the country for another 5 to 7 years? Or are they 2s and they're over 7 years of age and their useful life is a whole lot less? Or are they 3? They're just about soon to be packer cows. And we obviously value those differently, the 1s versus the 3s. And every rancher is going to have some of all of them. And so we've got to make sure we're doing our due diligence to not be putting $4,500 a head on a number 3 cow when in fact that number 1 cow might be worth that in today's market. So that's just an example. And we do feeders the same way, the grains. But what we do on the commodity pricing index is we take those values that we assign, and we actually have 2 of them. We've got a South Texas CPI, and then we've got a Panhandle and West Texas CPI. But why is that? Well, the Panhandle guys are closer to the market, right, than we are down in South Texas. So theirs has some positive basis built into their CPI that's a little higher than ours. But that's what we do. We actually assign value so that every ag lender, regardless of where they sit, are using these numbers with which to underwrite their loan. They're not just calling the sale barns, oh yeah, cows are bringing $5,500 this week, and that's what they're putting on a set of cows that they're financing. So that kind of volatility the examiners will just saying, what is this lender doing working for us if they're doing those kind of crazy things? So you have to index things and make sure that they're consistent throughout the company. So other economic factors that I have listed there, just, land prices, we know what those are doing. Real estate values it depends on just where the property is. I mean, what we used to think was just, an ag property versus something that's in the city limits. Well, now it's is it way out in West Texas or is it, anywhere close to I-10? The price differentials have changed so much in the last 15 years that prices have escalated nearly everywhere. Obviously, we're looking at interest rate and interest rate risks. We've got, who would have thought that what's going on in Iran and in the Strait would have an impact on agriculture in South Texas? Well, ask a farmer what fertilizer costs today because of what's going on over there, and they'll tell you right quick it's had an impact. So that's just an example of things that we know are out there. And then the impacts of weather. You guys got rain up here, right, over the weekend? Guess what we got in Victoria? Yeah. So, it matters. And where does that matter in terms of the risk as it relates to the credit? Well, we've got corn down on the coast that's about this tall. It really would like to be about this tall. In about 2 weeks, it would like to be tasseling, and it's dry. So if you're the farmer and you happen to like the price point that we're at today, if your corn's under stress, Do you really want to lay off any more bushels per acre and market anything if you're doubtful whether or not you're even going to make a crop? As opposed to if you're in Brazos Valley and you got corn that tall and it's, never going to be another tough day, at least until we get the next rain, you might lay off a few bushels right now because of the rain that you just got. So it's all about marketing, but it's weather. So yes, we evaluate all those things and try to stay on top of them. This is an example loan that we did before. Other than while you would turn down the loan, we're not going to go through it. I'll just hit the high points of it just so you kind of understand how we evaluate. Obviously, you would change the name of the cattle company if you were going to make this loan, or if you had a choice to change the name. But this is a real live example, and what this is a sibling in a family that is buying out the family on the ranching operation and is going to lease back the entire ranch that's remained undivided, like a lot of families do. The ranch, the ones that live in cities or live in town, they still remain an owner of the ranch because they want to hunt and do everything that they can on the ranch and enjoy it. But they're going to let somebody else be the rancher. In this case, one of the siblings is going to be the rancher. He's buying, in the second bullet, buying 500 cows, 20 bulls, and it's got a few calves on the cows. Some are pairs at a cost of $1,835,000, and you can see what how those prices came together. We'll loan 75% of that number, which is $1,376,000, which is the top number listed there. SLOC, straight line of credit. That's almost like a construction to perm house loan. So while the house is being built, you want to lock in the interest rate day one, right? Because I like it today. So before I break ground, I'm going to lock in the interest rate with Prosperity Bank because I don't want any interest rate risk. While the house is being constructed, I'm drawing on this line. I'm doing construction draws, right? Same thing. This borrower, he knows he's not going to buy all these cattle in one single day. They're going to palpate, they're going to work the cattle, they're going to evaluate how many are pairs, how many are dries, so on and so forth. So he's going to need to make draws over time, just like that construction loan. And then once he's through drawing up on it, if he uses the entire $1,376,000, that's the amount that we amortize over 5 years. He may not use that amount because of the makeup of the cattle, because it was a guesstimate at best when we came up with that number, because he doesn't know until they go out and palpate cows exactly what the makeup of that herd's going to be, right? 7% interest, repayment plan, 6 months interest only during that draw period, and then it'll go into a permanent payout. We need to make sure we time that annual payment. This is an ag banker versus somebody that's trying to be an ag banker and might not know what they're doing. Do I want that payment due like a lot of people do? I'm going to make it due on December 31, or I'm going to make it due on January 15th so that the borrower can, decide whether they want to sell the calves in last year's business or this year's business. Well, if I'm a rancher in South Texas, which is where this operation is, and I harvest my calf crop in September, and you're asking me for a payment in January before the calf crop got here and even grew up and were available in September, that payment's not at the right time of the year, is it? So you need to set that timing up for where the cash flow comes in. Same thing with a crop loan. Reister talked about farming on the coast. Well, we set our maturity dates, obviously, sometimes after, depending on whether the farmer typically holds grain over or not. We set our maturity dates according to when the cash flow is going to come in. So moving through the numbers, everything there, we did a break-even analysis in the second column. Basically said that at 85% calf crop and a calf weighing 650 pounds, those calves need to sell for $250 a pound to break even, to make all of that debt service that's described in the bottom of the left-hand column. And then the last thing we said is, okay, before this borrower's taking on all this debt to buy these cows, what did he look like on paper? And that's where we do our credit analyst spreads and just look at their tax returns. He showed in 23 a 2.2 coverage, 24 a 1.85, and in 25 a 1.2 coverage. Then you've got to explain why the 1.2 in the most recent year is that low, when that's kind of our minimum standard, is that they shouldn't be over below about a 1.25. But in that case, he needed to pay the family for the lease, even though they've not yet conveyed the cattle over to him. We've already approved this loan, but they're in the process of getting this put together and done. He needed to go ahead and pay the lease. And so that coverage ratio is calculating, he actually paid it last December. He's got a lease payment with no cattle income. So you've got to make sure that you explain that in your narrative and your write-up to say, here's why it's that way. If you adjust that back out, But I on purpose showed it this way without adjusting it out. If you adjust out that lease payment, his cash flow goes up to about a 140. So it's more than acceptable. So everything else is just saying, how can you evaluate the risk? What could you have done to change things or make things better? Assume this was a really young borrower, maybe borrowing money for the first time, doesn't have a credit history with us, doesn't have a balance sheet that's any better than what mine was when I walked out of a classroom at A&M, and if I wanted to do it, because this guy's pretty young. Comes from a fairly wealthy family, but it's not on his balance sheet. And so the very last item that's listed there is what we did. We put an FSA loan guarantee in place on this loan for a 3-year operating loan. That's only the operating loan. Well, one of the things that's a weakness in this thing that I pointed out in here is where is he going to get his operating money for? In his business model, he didn't put any interest carry in his plan for having an operating loan to pay lease, pay feed, pay for all these things, because a rancher starves to death until he sells that calf crop, right? If he doesn't have any other income source, how's he going to pay the bills? So this deal is crying for an operating loan that's not even mentioned in this package. This is what he presented us with, but we ran the math on it and said you're going to probably need about a $200,000 operating loan. We factored in the interest carry on that, and the cash flow coverage was still more than acceptable on this deal. So FSA approved the loan guarantee, and we're in the process of getting this loan booked right now. That's just a kind of a quick story on what this deal looked like. So to kind of wrap things up, I thought I'd just kind of give you some helpful hints, things that I've learned over the years. What do I look for, whether it's in a customer or borrower? What do I think you need in business? What I think you need to be if you want to be a banking career or an ag commercial, a commercial lender of any type. More than anything, initiative. The proverbial fire in the belly. Our credit analyst program is a 2-year program. I always exaggerate anybody that we talk to, and we've just hired a student that we just accepted the offer from our Ag Economics College that'll come to work for us on the 1st of June. But I always tell them, we're going to put you in a dark room for 2 years, give you a computer, and you're not going to see the light of day for 2 years because you're going to be an analyst crunching numbers. And then we tell them the real stories. And no, it's not that way. Not if you're in Victoria. I can't tell you what the Dallas guys do with their credit analysts, but I can tell you what we do with them. We integrate them in our team because we want them to see the other side of what it is they're doing. Yes, all they're doing is number crunching for 2 years, but I'll tell you, that word initiative, fire in the belly, there's not anybody in this room that probably can't do that job in a year instead of 2 years. And if we can pull you out of that program because we think you're ready in a year, that's all the better. And more times than not, we've pulled them out of that program in less than 2 years, closer to 1 year than 2. That's what we're looking for. And that's what anybody's looking for in the business world, is somebody that's got that kind of fire to make things happen. I can do this is self, just having that self-confidence to do that. So the next bullet, talking about the younger generation's acceptance in your profession, that's one of the things that is really difficult, but it's just there's not any way to describe it other than it's real. It happened to me 40 plus years ago. It happened to McKenna, our daughter, that's been through this. She's a survivor. She's been through this program. When you're young, especially female, in a predominantly male business like farming and ranching, not being chauvinistic when I say that, I'm just being realistic, you're going to have challenges because you're young first. And you're going to have, dyed-in-the-wool rancher, dyed-in-the-wool farmer, and what do you know about my business if you're half their age or a third of their age? And that's just a challenge we all have to overcome. Here's what I do. That credit analyst, I put them in my office, particularly when they're on the end of starting to underwrite, because that's what we do. We don't just say, okay, now you're a lender. I take them and say, underwrite some of my packages for me. Underwrite this deal that I just showed you. You do it. You put it on the law, what we call the law loan approval worksheet. Put everything, fill in all the blanks. Help me write the narrative, that explains the story behind this ranching operation. And when you do all those things and you do it and you plagiarize, you look at what's in the file, That's how I get good at what I'm doing. I learn the style. I learn how it's being done rather than trying to reinvent the wheel. So all of those things help you get to where you want to be. But ultimately, we want that credit analyst to shadow us that have got the experience. And then when they're ready to underwrite a deal, and I need them to be the lead, take the lead with the customer or a prospective customer, generally what I'll say is something like this. Look, Travis is in the room with me today because he's going to underwrite your loan package. I'm here with you. You know my phone number. You've got my email. I'm here for you anytime you need me. I'm not going anywhere. But the rest of the story is if you want this deal done, it's got to go on Travis's desk, and he's going to make things happen for you. And he's going to underwrite it and make it happen, and I'm going to be there for oversight. And we're going to get this deal done for you, or to whatever level we feel confident that it's a bankable deal. But when you give the customer that vote of confidence that says this young man or this young lady is your solution maker, this is the person that's going to get the deal over the finish line for you, the problem goes away. But you got to have that kind of interaction for that age problem just to not really show itself out. That's enough there. The last things I'd leave you with are the things that we listed at the very bottom. What do we look for when we're hiring commercial lenders, ag lenders? And keep in mind, I stayed on lending because that's my background. But folks, there's a Y in the road on anything that relates to what we're talking about today in commercial banks. A bank our size, we've got a trust department. And so let's say you like numbers, but you don't like the people side. You don't want to be customer facing, but you like everything that we're talking about, and you want to be the analytical person. We've got loan review, we've got audit, we've got compliance. All of those are internal, and all your customer is me, the lender, because you're looking at my deals after they're made. Did they underwrite them the right way? Okay, we're in year 2 or year 3 of that deal. Are the numbers still suitable for what they are? Is this loan properly graded? We go on a grading system. Grade 1 is basically CD secured or cash secured, so there's no risk. That's why it's called a grade 1. Most of the credits that have either weather or market risk, even market volatility as in equities or stocks, those are all grade 3 pass credits is what they are. They're not even grade 2 or above, basically low or no risk still, but not CD secured. So again, that's how we look at those things. So that's where job functions can really be in different areas of the bank. Our trust department, everything from certified financial planners, 5, certified financial planners, so personal trust officers, they're doing everything from probate to estate planning, helping people with wills, to doing employee benefit management for small companies. We do that up in our trust department where we actually manage their company's 401k plans for them. So we have, and those analysts need, a lot of them, defer over to our trust department or one of the other job functions that I've talked about. So there's lots of different opportunities, not just in lending, but what we look for is 12 hours plus or minus, and I say plus or minus because it may be finance hours, it may be Reister's rural entrepreneurship class, and we'll almost take half the amount of hours if you go through his program, just because we know what that product looks like on the other end. We've been there and done that. We've seen it. And the degrees that we pick from are listed there. Ag background for ag lenders, yeah. I mean, you got to know the difference between a cow and a steer and corn and cotton. I mean, it's just, and I'm exaggerating on purpose. Our credit analyst program are comparable is what we look for when we hire somebody straight into a lending spot. Master's and graduate degrees aren't required. We take them, but they're not required because we put everybody through this analyst program because we're teaching you the way we underwrite in a very short period of time. Again, that short period of time we hope is a year or less, but we prepare for our undergraduate students to be about 2 years to make sure they have a good opportunity to be successful. And then the last thing I'll leave you with is people skills. If you're going to be customer facing, the value we put on that. And the whole reason is I started out this conversation with, being active in the community and being out in the public. That's what banking relationships are about, and that's how you build them. It's people you meet at church. It's people you meet at your kids' school activities. You know, sitting on Victoria College Board of Trustees, you know, we talk about our transfer student program. We talk about Team Blend. How can we make Victoria College's program better than what it is? A&M Victoria is now, you know, there because we struggled as University of Houston in Victoria, and the legislature saw fit to bring A&M to Victoria. That'll be a growing program over time. It'll take a while to really get its feet underneath it. But we're very excited to have A&M in Victoria. Why? Well, two reasons from a business and occupation standpoint. What our needs are in the Victoria MSA is affordability. So those students a lot of times are going to be able to live at home or live closer to home. Cost of living is going to be less. Education will be slightly less. You're still at a four-year university and you're still at A&M, so it's going to cost. But so many of those students can start at Victoria College, our community college, and then transfer over to A&M Victoria, no different than they would transfer to A&M College Station. And they're staying right there at home, maybe working part-time and working while they're going to school, and don't want to disrupt that income flow that they need. Our average age student in Victoria at Victoria College is 32 years old. Our average age student at what we think is going to be at A&M Victoria is right around 40 years of age. So it's largely female that's maybe raised family or raised some family and is now going back to school. A lot of it will be on the medical and nursing side because we have a huge need for that in our area. But we have a need for a broader spectrum of degrees than what U of H offered there. So not what asked me to come here to talk about, but I'm from Victoria, and a lot of people ask why. You know, why is A&M in Victoria? And so that's all I had. And appreciate the opportunity once again. Thank y'all.